Hello, everybody. Welcome back to the weekly rebalance. We've been on hiatus for a little while for some personal reasons and some travel. Just a lot of stuff going on this summer, but we are back and ready to get back into some markets and the Fed and all kinds of stuff today. So excited to be back. Nick, how are you doing today?
I'm doing well. I'm excited to be back also. It's been a good little while here. So I went on
It has
vacation and then we had everything going on, so it's been a bit.
certainly has, but that'll make for an exciting day today. We got a lot to catch up on, a lot to cover, and there's a lot of exciting stuff going on, or at least interesting stuff.
Certainly, certainly.
Well, we'll do our normal thing. We'll do some market catch up, which we're going to be kind of heavy on today, and then tie that right into our research of the week, which is covering the Fed, or the what I should uh, better refer to as the new Fed, with Warsh and his new conferences. So, a lot to cover today. Should we just jump right into it, Nick?
Yeah, I like it. Let's dive in.
You wanna give us what's the deal? Markets. We haven't caught up in, we've obviously caught up internally, but we haven't cut the podcast up on the last 6 weeks or so. What's been going on? Where are we at? What are things looking like?
Yeah. Well, it's been an interesting little bit here. Year to date, I mean, I think just backing up and getting an idea of where we're at year to date with major indices is a good place to start. So taking a look at everything here, our top performers, at least when we bring in these four indices here, our top performers are US small cap, proxied by the Russell 2000, and emerging markets, both up close to 20% year to date. So we were increasing our allocation to those particular parts of the market earlier on this year, and been happy with that performance so far. Aside from that, here we've got the S&P 500, and we've also got the MSCI World ex-US Index, which will be our developed markets proxy. And they've been trading somewhat in line throughout the year. Still not a bad year so far. S&P up 10.14% year to date. Developed markets edging that out just a little bit with this particular index we're looking at here. But long story short, year to date, it's been great for US small cap and emerging markets.
Yeah, totally. A very, very good year. Under the hood, though, it's been definitely, I'm talking now more specifically on the S&P 500, but especially the last month, under the hood, there's definitely been a rotation happening.
Yeah.
We've obviously the last number of years, the AI and the AI infrastructure trade have, they've been the leaders, and that's been reconsidered to some degree here, at least in the last couple of weeks to month or so. And that we've seen some other leaders kind of rotate in and take the performance threshold, up a little bit higher than that AI trade. And a lot of those companies are now trading at notable discounts, at least to where they were, a couple months ago, or at the beginning of this year.
Certainly, certainly. A number of those players being top of the market cap, in addition to the Magnificent Seven kind of lagging behind a little bit. So that's been a really interesting story to follow. I think a good illustration of that is comparing the market cap weighted S&P to the equal weight S&P year to date. And you can see here, year to date, actually, the equal weight S&P has outperformed the market cap weighted one by a decent little margin here, a little over 3%. So that's been an interesting rotation to watch, especially since, when you bring it into the context of the past 10 years where market cap weighted S&P has really been taking off and leaving the equal weight in the dust. So that's an interesting leadership change that we're seeing occur there. And it just highlights some of these higher market cap names that have really been driving performance for so long are starting to lag behind a little bit, and the rest of the market is starting to catch up, which I think is a healthy sign overall, and a good thing. But it makes for interesting content for us to look into. Looking into that too, I think it's interesting to look back on the relationship between the equal weighted S&P and the market cap weighted S&P, because at least for most of the time while I've been into finance, which hasn't been all that long in the whole scheme of things, but if we look at 2010 through today, market cap weighted S&P has really outperformed the equal weight one, when historically that really hasn't been the case. The 90s, the 2000s, equal weight really outperformed, and you can see that manifest itself if we look at the performance of the equal weight S&P compared to the market cap weighted one going back to 2000 to today. Built up a large enough margin that even over the past 10 years, where we've seen a lot of leadership from those top market cap names, equal weight still outperforming there over that time period. So interesting to see that. I would say probably more typical relationship play out, since through the majority of the 90s and the 2000s, we actually saw equal weight outperforming. So good to see that breadth in the market nonetheless.
Yeah, absolutely. There's some health to me that is somewhat healthy to see breadth coming into the market. To see earnings also catch up to prices is another positive thing, which we have seen even in the top of the market cap that was potentially, as we called out on some of the earlier podcasts, potentially getting a little bit pricey. What's been nice to see is we've seen prices stay, fairly stable or even trend upwards a little bit, but earnings have caught up. I was just looking at a chart, looking at the July 31st numbers, but the price to forward earnings now in the S&P 500 is 19.6, which is somewhat notably lower than it was at the beginning part of this year before we launched into 2026. And that's healthier in my view. When you look at things like, the 2000s, when you got PEs close to 25 or over 25, 2020 was in the 19s, 2022 in the 21 plus. You start to stretch the ability of the market to continue expanding those multiples when you get above 20, and especially as you get further and further above 20, like we did in 2000. There's been a lot of comparisons to what's going on today with the AI infrastructure boom compared to the web. I think there are some meaningful comparisons to pay attention to there, especially as valuations get somewhat lofty. But it's healthy to see actual earnings catch up there. And that's where I think there is a difference in this round versus what's going on with the web. It's a lot of publicly traded websites in 2000 that essentially provided no value, had no economic impact, but were just first to market in the sense that they had a .com website. There's some real spending going on here from these massive hyperscalers. There's a lot of use, like we've seen in our own company, like I'm sure many are seeing, the use of actual AI large language models and their ability to speed up work and whatnot. There's a lot of reality to that. That's not to say that can't be overpriced, but it was really healthy, in my opinion, to see breadth coming into the market, like we've already talked about, and also to see earnings actually catch up and justify some of the more lofty valuations. And we've had a great earnings season. Again, we're into quarter three earnings. As far as I looked at the S&P last, I think 90% have actually beaten earnings after they've reported. So there's a lot of positives to be taken away here, and a lot of this is, there's some health displayed in the market from what's happened the last couple of, let's say, 4 to 6 weeks.
Yeah, certainly. I mean, I think at the aggregate level, you definitely see that. It's easy to draw those comparisons to the early 2000s, especially when you have names like Palantir, who just reported earnings yesterday, trading at such extended valuations. But even then, their earnings were pretty impressive. Now, their multiples are still pretty extended, but decent earnings and a decent outlook from them as well. So there's certainly parallels to draw there, but at the aggregate, and I think underneath the surface as well, it seems like we're moving in a more healthy direction.
Yeah, agreed. One of the obvious big question marks that to me, there are a couple big question marks. One is obviously earnings. So we've seen that answered for this quarter, at least again. The other, what's happening geopolitically with Iran, which we could, it's funny, we took a hiatus, came back, and we're still talking about Iran. hard to cover what's going to happen there because who knows? It changes by the minute. But the other big piece that we're going to explore a little bit more detail today is the Fed, what's happening with the new chair in Chairman Warsh, and what bond yields have done over the last couple of weeks has been pretty notable.
Yeah.
So I don't know what your thoughts are on that, Nick.
Yeah, absolutely. I mean, it's been an interesting turn to watch here. I think the press conference last week was entertaining above all else. I mean, it was fun to watch that one. Didn't get a ton of information out of it. I think everyone left the meeting feeling that way, and that's intentional. We kind of knew that that was going to be the case going into it. Uh, Nonetheless, pretty entertaining press conference so far. So, Warsh is off to an interesting start.
Yeah, I'm very interested to watch him at Jackson Hole at the end of this month. That's going to be his first really extended speech, and very, very intrigued to see what he'll say. But you're right. It created this, kind of the classic bear steepening, where you saw the short belly of the curve kind of set, the go down in yield, and the long end extend and actually hit some highs, at least for near terms. I think the 30-year here, 30-year actually was its highest since 2007 on
Yep.
right after the July 29th commentary from Warsh. And even the 10-year was I believe it was an 18-month high.
Yep.
4.75% is what I saw. It's down a little bit from there now, but classic kind of bear steepening where the long end is, selling off, yields going up, and, inflation pressures, persistent issues there, are, there's some unknowns. And, really, if you think about it, the less forward guidance from Warsh is, the market's kind of demanding more compensation for the uncertainty on the long end of the curve. So you're seeing yields float up, which is, going to be challenging for people trying to finance longer term purchases like houses.
Absolutely. And I mean, that's somewhat by design as well. Warsh has been pretty adamant that he wants the market to kind of price things and figure it out. They don't want to be, I think his words are, he wants the markets to not be playing the ref. He wants them to be playing the ball or what's going on in the market right now. So I think that's intentional for the most part.
Yeah.
Um, you know, Remains to be seen whether that plays out well or not. And I think there's some really interesting parallels to the Greenspan era at the Fed that we can dive into later. But I mean, this graph really, this chart of the yield curve really highlights how the bond market reacted to his speech last week. Pretty
Yeah.
notable move on the 30-year there. So the market is tightening lending conditions on its own, which again, I think is part of what Warsh desires. Now, depending on how much more guidance we get in the future, things of that nature, we'll see how volatile it gets in the bond market, particularly if they ever end up hiking or lowering rates, which is an interesting conversation in and of itself, since pretty much any prediction market or the Fed watch tool as well, pretty unconvicted on whether we're going to get a hike or not. We're leaning towards a hike right now, but all of these different metrics that we typically look at giving us an idea of where things are headed, not very convicted right now.
No, yeah, definitely not. Well, and let's just dive in and continue with the research of the week and where Warsh is at. You said you had some interesting comparisons with Greenspan. I'm curious what you're thinking there.
Yeah, I think Greenspan's tenure at the Fed is an interesting parallel for a number of reasons. I mean, number one, he managed the Fed through the dot-com crisis as well. So I know there's a lot of parallels that get drawn between today and that time. We were just talking about it earlier. We think that there's some reasons to be optimistic around that, but the parallel gets drawn nonetheless. So I think he's an interesting comparison from that perspective, but also in the communication style that he had at the beginning of his tenure versus at the end of his tenure, I think is an interesting thing to bring up and compare it to what we see coming from Warsh today. And so I guess to start off with, in 1994, towards the beginning of his tenure, um, didn't offer too much forward guidance at any of their meetings. There were almost or there were no post Fed announcement meetings and no forward guidance, essentially. And that came from his predecessor, Volcker. He was largely silent as well. And so that was just kind of the way things were done, and sticking with the status quo. On his first hike in February 1994, it caught the bond market off guard. 30-year Treasury yields surged above 8% by the year end. Mortgage rates jumped more than 30%. Basically, just the bond market wasn't ready for it. They were taken by surprise by the lack of forward guidance. And it was a pretty volatile reaction, especially at the long end of the curve. Now, at that time, they were being pretty aggressive. I see the Fed ultimately raised the fund rates by over 300 basis points that year. So that's over about a year. So that's a pretty aggressive hiking cycle. And especially with no forward guidance, not surprising to see the bond market have a very volatile reaction to that. But I think it's interesting to compare that towards the end of his term in 2004. He kind of created his own version of what the Fed should look like. He invented the Fed speak model, which is basically, let's come out, let's give an idea of where things are headed, but try not to sway the market too much one way or the other. That was, where that Fed speak idea really came from for the most part. And so I find it interesting that at the beginning of his term, he was more along the lines of what we're seeing from Warsh right now, no guidance, or very limited guidance, very limited commentary, kind of keeping everything obscured from the market for the most part. And then towards the end, he had moved towards a more open guidance style. So I find it interesting that Warsh is starting his term with this more opaque approach, especially since we see in the past someone moving towards the opposite, starting in a similar area and moving towards the opposite. So I found that to be an interesting parallel.
Yeah, it's very interesting. It's interesting to see how Fed chairs change. The other thing I think, Warsh is obviously, he stated he wants to give less forward guidance. He doesn't want to, potentially even give the dot plot. Certainly, he's even floated the idea of less press conferences, which is very different than, less press conferences and actually less meetings as well. We'll see if that comes to fruition or not, but that's very different than Powell. The other thing that I think is really different than Powell, which is a key focus right now, is Powell was less harsh on price stability, inflation. Powell consistently in his commentaries would talk about an average inflation of 2% or whatever their target was, right? But Warsh is much more harsh on that, saying, I believe his exact quote was, the committee will deliver price stability, and it's a hard 2%. So these are meaningful adjustments, just like any Fed chair change is meaningful. But this is particularly meaningful because he's very different than Powell. Whether you like it or don't like it, and the success of this is you can't judge the success of this until much later on. But regardless, from our perspective as market participants, it doesn't really matter. We have to vote with our dollars, vote with our allocations. But it's certainly something to pay attention to, because it's a very different Fed and very different press conferences and meetings than we're used to. And you saw that with that move. Like it looks small on that chart that you pulled up on the screen, but that's a big move, especially in the 30-year. The 30-year is much more stable than that in most cases. And to see it move as much as it did in one particular day was pretty notable.
Yeah, well, and I think it's really interesting to put that in the context of when Warsh came in, he was perceived as a hawk, very committed to that 2% inflation number. And as time has gone on, that's come more and more into question. And you see that play out in the bond market at the last press conference. The 30-year going up and the short end of the curve coming down, that's an indication that the bond market isn't so convinced that he's going to hike to control inflation. 30-year going up, that means they're concerned inflation is going to be a problem for longer. Shorter end of the curve coming down, that suggests that, hey, I don't think we're going to see rates go up here, at least not as drastically as was priced in before. So, yeah, it remains to be seen what's going to happen there. But I think the bond market's trying to figure out where he's headed with things.
Right. And yeah, exactly. Well, and one thing I wanted to do today was kind of go through the case for and case against the Warsh approach, because I think it's too early to judge what's going to happen here, but we have to understand, both sides of the coin. What's could be successful, what's the case for Warsh's new approach, and what's the case against, so that we can see how they play out over the coming months and really years. I don't think this really can truly be assessed for a long time. But I had 4 different categories that I wanted to kind of discuss: credibility, volatility, independence, and inflation. And I figured we could talk through really quickly, the case for and the case against each of those things, if you don't mind, Nick.
Yeah, let's do it.
So the first one was credibility, and I feel like the case for, in Warsh's view, and I don't know what you think about this, but a quieter Fed, let's just call it that lets the data kind of speak and avoids oversteering markets, which is, I think, what Powell has kind of done to some degree, right? Is kind of given lots of guidance, steered markets to keep them calm. Basically, the quieter Fed should let the data speak and avoid doing that, and it stops policy from being basically hostage to every monthly new economic data that comes out. Is that a fair, the case for, in your opinion?
Well, I think so. I think it gives the Fed more flexibility to be able to react to the new data as it comes out. Because in the past, when the Fed has projected certain paths, they've had to stick to them to maintain their credibility. So by withholding some of that forward guidance, they're not setting the Fed on a predefined path that they have to stick to, or otherwise lose their credibility. So I think it adds to the potential flexibility to change to new data, and it doesn't commit the Fed to a path going forward, or as strictly as maybe in the past.
Right. Well, in the obvious case against is more volatility. Much wider range of outcomes and more volatility, which can create angst for market participants. But that's the clear case against it. We've been in this period where, again, and that was the next category, kind of connected volatility, as the next kind of dimension to look at. But removing that, the case for that is kind of dot plot chasing. It kind of whipsaws rate forecast. That's the getting rid of that issue is great, but the case against that is obviously that stable, the last 2 decades of stable guidance has significantly reduced rate volatility. We've already seen that unwind to some degree. Look at the 29th and the chart that you had up, which is showing how much the 30-year moved. That's abnormally high volatility for the 30-year based on the last 2 decades. So that's likely to continue unless Warsh changes path and all of a sudden starts giving commentary more like Powell.
Yeah, definitely.
The other one is independence, which you kind of touched on already. But if you're not, I think the political angle of this is interesting because he came in and was supposedly Trump's pick, which I'm curious. I wonder what Donald Trump thinks about this. But Warsh kind of came in when it was Trump's pick. But if he's giving less guidance, not relying on the data more frequently, and not being held to hostage by pre-printed policy, the politicians should have less ability to interact with them because they're going to get surprised just like everybody else. Do you know what I mean?
Yeah. And I think that was an interesting thing, watching the financial news coming off of the press conference. Well, a lot of people's reaction to it was, oh, what's Scott Bessent going to think? He's probably taken by surprise by this. A number of other Trump appointees as well being taken by surprise. So Yeah, I mean, that it doesn't seem like he's being too impacted by an outside influence. So, remains to be seen. We've only had 2 meetings so far, but
Right. But it systematically, technically speaking, he can't be as impacted because there's just less, nobody knows what's going to come out of the next meeting, which is a positive. It's kind of funny that that was such a big concern going into Warsh's appointment. But his approach is really one that actually leans on more independence from the Fed. The negative is the Fed is already, an insulated institution, and less accountability, less public meetings and whatnot can kind of create, um, you know, potentially less public accountability. But, I think it is actually his regardless of what you think about it, him being appointed by Trump and him being Trump's pick, the way he's handling things is one that actually distanced himself from being manipulated by politicians.
yeah, there's certainly upsides to that.
Yeah. The last one is inflation, which we've already talked about a lot, but I believe Warsh, what did he say? Inflation is a choice. Very hawkish statements there, and totally different than Powell. And if you have a pretty rigidly hawkish stance, you could be at risk of over tightening in an economic slowdown. So, again, there are positives and negatives to each of these. A lot of this is just differences that are going to be hashed out over the next couple of meetings to a couple of years, but we'll have to see. But there's reasons for and reasons against the new approach, but I think it's obviously being called into question because of the stark difference versus what Powell was like as the chair.
Yeah. Well, let's stop on that inflation point for just a second, because I think that's really interesting too, and was, I guess, a flashpoint within the press conference that we got last week. But talking about Warsh's measure of inflation, because he's expressed his skepticism about PCE alone, basically saying that he thinks it's somewhat of a flawed metric to just look at that one measure of inflation by itself and not include others in some sort of index. And nobody really knows what his end idea of an inflation measure ultimately is. And he got a question about that in the press conference and basically said at this point, not going to go into that, and you'll get more about that at the statement that the Fed releases at the beginning of the year for their tools and practices going forward. So that's another interesting thing as well. For the longest time, we've relied on PCE as being known as the Fed's preferred measure of inflation, and going to be interesting to see what they come up with. I'm sure there's a task force working away on that, but going to be neat to see what he comes up with.
Totally. Well, and lots to watch going forward. So we'll have this will definitely be a repeated topic as we progress through the rest of this year and into 2027 as well. But for now, lots to watch here. Jackson Hole coming up at the end of August. You got the September FOMC meeting, and then obviously, since they're supposedly paying closer and closer attention to the data, watching the inflation data, especially energy, how it's impacting the different inflation metrics, is going to be really interesting. And then the dot plot, whether it actually survives or not, we will see.
Yeah, well, he didn't release his dot plot at this press conference, did he? Right? That was not something that got released. Yeah.
Right. We'll see if that disappears for good.
Yeah.
Well, anything else you had on thoughts around Warsh? That kind of covers what I was thinking.
No, still a lot of question marks up in the air. I think we're going to have to give it some time to see how things play out.
Yeah, definitely. Well, I have one good trivia question for you.
All right, same here.
Do you want to do a trivia question each?
Let's do it.
All right. You want to go first? You want me to?
You go on ahead.
All right. So as we've already talked about, Warsh's comments have been dramatically shorter. I'll give you a hint here. Powell was normal to give a 300-word statement.
Mhm.
Warsh, his first statement, how many words was it?
Ooh, I think I saw this figure come up. Was it like 180?
It was actually shorter than that. 100, it was about 130 words.
Wow.
So less than half the normal statement from Powell, which again, I think just sums up exactly what we've been covering here for the last 20 minutes. It's a lot less shorter, more straight to the point and deliberate communication. That's exactly what he did, and it showed in the number of words, 130 words versus the normal 300-ish or more from Powell.
Yeah. Well, and the entertainment factor on their press conference as well, just through the roof with Warsh. Just a lot of questions, very little answers. It was pretty entertaining to watch.
It was.
All right, I've got one for you about Greenspan. We'll go back to that topic for a minute. Okay, so best known for his tenure at the Fed, also his nickname being the Maestro, at least at the time, since he orchestrated a number of soft landings and his handling of the Fed. He played two instruments growing up and was actually, pretty successful as a musician. Could you guess one of the instruments that he was proficient with?
I have no idea, but I'm going to guess the violin.
That's a fair guess. Yeah, it's the saxophone and the clarinet. He was in a jazz band for a number of years, and actually, he learned from Stan Getz, who was a very prominent jazz musician, especially from his era. He toured in a band for 16 months. And I think during that time, he did the other bandmates' tax returns, and he said he realized where his real talents lied. That being said, he did attend the Juilliard School for 2 years as a clarinet student, so I don't think he was any slouch as a musician either.
Obviously not. No, I did not know that. Very interesting. So the saxophone and what was the other one? The clarinet?
Clarinet, yeah.
Okay. Very cool. I did not know that.
Yeah, that was an interesting one. All right.
Awesome. Well, yeah, that wraps it, I think. Anything else you have? Any final closing thoughts?
No, nothing else from me.
Good. Nothing here. It's good to be back. Good to talk to everybody again, and we'll be back again next week.
All right. Thanks, everyone. Bye.
Thanks, everybody.